Hey, good morning, everyone. Marty Missouri here, 24th of September, 2022, Saturday, with a economic update for you. Also, I will spend a minute at the end and update you on the S&P 500 and a few other interesting factoids that I want to fold in as well. So we'll just jump right in. We actually improved a couple of points again this week on our index. Still a -7, still in a scenario where odds favor recession, either currently or in the near term, versus continued expansion. As usual, of our 45 data points, I selected a handful to share with you here today. Starting with housing starts, which came out this week for August. We actually saw a nice uptick. However, the bulk of that was in the multifamily space, rental space. Here was just a small uptick in single family, and housing permits, they actually declined a bit here, both in multifamily and single family. For single family in particular, you can see that's a pretty bearish looking graph right here. I think this was the 6th month in a row with declining housing permits. And which kind of exacerbates what has still been a pretty weak inventory scenario. There's supposedly a lot of inventory coming to the market. But of course, when we're seeing permits decline, then that would suggest less inventory. And that is a support for housing prices. Again, we're not bullish on housing right here, nor are home builders. Folks, with these surveys, if 50 separates recession conditions from expansion conditions, as you can see, the home builder sentiment just absolutely continues to plummet. Okay, initial jobless claims. Now this continues to be encouraging. Recall how recessionary this look was, this rising off of here compared again to history. That's just kind of an ominous look. It seems like when you see jobless claims begin to tick up, you can pretty much count on a recession coming, which of course is still our base case. But to see it come off now for a few weeks in a row is encouraging, and continuing claims seem to be rolling over here a bit as well. Also on the positive end, truck tonnage kind of surprised me, honestly. Picked up a little bit. Of course, trucks moving stuff across the nation's highways. So a pickup there speaks probably as much to bottlenecks opening up as it does demand for goods. Economic surprise index continues to surprise. And again, never forget, this is just the data coming out compared to the consensus estimates among economists for that data. When it's going up and it's now in the positive, it just means the economy has been better than what economists had forecast. This means the economy was worse than what economists had previously forecast. But again, on balance, it is a positive sign for the overall state of the economy, but it does not mean we are continuing to expand and the economy is picking up. In fact, quite the opposite is what we've been seeing of late. And then the, I think, all-important leading economic indicator to coincident economic indicator ratio. This has been a very good recession warning signal for us. As you can see, it's not perfect. You do have rolling over here. And folks, you may recall that when we were calling for recession up in here, we were pointing to this as well. And I said that the likelihood of 3 false signals, and this actually in retrospect made some sense. Both of these did when you looked at what was going on, but they did not lead to recessions. We were pretty firmly committed to our recession outlook here. And of course, COVID, brought it forward perhaps and exacerbated it for a couple of months, but also inspired the most astounding amount of response by both fiscal authorities and monetary authorities, to the point where the Fed actually did some things that you didn't think they could do per the Federal Reserve Act, but we of course spent lots of time on that. And that kind of puts us where we are here today, but here we are rolling over, and very, very recessionary look there. Okay, so there is your quick economic wrap for the week. Let's look at the market really quickly. So I did a snapshot yesterday, and remember yesterday morning on the written blog, we drew this bear flag pattern, and folks, it literally played out to a T. Bear flag, the way it works, and this is a real confident looking one, is you get kind of a waterfall sell-off, you consolidate up a bit for a few periods, and this is the hourly chart, so each candle is an hour. And then when you break down, the target would be the length of the flagpole. So you just copy that, move it down here, and there you go. And then bounced off of that. And I'm going to show you why that also is a very key level here on the daily chart. So we'll see, folks. We'll see if this bounce lasts into next week. Nothing else bullish on this chart just yet. If we do get a thrust here on Monday, then of course we'll get something positive looking here on the MACD. And then on the 1-year daily chart, look where we tapped, right at the June bottom. Some people say that's it. Some people said the bottom is in. Well, they're going to be tested here come Monday. But that is right where buying came into the market. The bear flag on the daily played out pretty well. And we're still in oversold territory. And I showed you this last time, right? Oversold, boom, oversold. A little bit of a rally here, gave it back, and then we rallied into that. Oversold in here, a little bit of a rally and so forth. So it would make sense coming off of oversold levels. You can see we were just about there here a year ago before we came forward. So I did want to push this back on a 5-year look here, and this morning before I turned this on, I drew this retracement. So these Fibonacci retracement levels are widely used by technicians, so we want to pay attention to them. So what you do is you go back to the very bottom, the COVID bottom, to the all-time high, right? And then you look at retracements. So what we have here is the market just busting through a 38% retracement of this monster rally. Okay, and right now we've been taken back, almost 2 years. So folks who got real excited here pretty much given back almost a couple years of their gains so far, right? So didn't even hesitate right there. You can see it kind of held here pretty good. We got this rally, battled a little bit with that 38% retracement line, then we came out of it. Our 3,500 target, by the way, coincides almost perfectly with a very meaningful 50% retracement of the rally. A little bit below that, if we overshoot, then we are right at the pre-COVID high. Okay, so basically this amazing rally, some would call it a new bull market because this was more than 20%. Personally, no, I think this is just an extension of the bull market from 2009. We're now in a bear market. That bull market officially ended here for us. And now we're entering a new regime in a lot of ways in our view. But we do think, of course, a new bull market will be at hand, and maybe not in the too distant future. But we're not making that call just yet. But we did think that a 3,500 bottom made some sense. And that is predicated upon the recession, if we do have one, being a relatively mild one, and the consumer holding up pretty well throughout. Of course, our analyses are dynamic, as is the market and the economy, so that could change, right? And we could get more pessimistic based on the data as it comes in. The technicals and the data are telling us this makes some sense, so we'll see. Okay, so let's take a look at some sentiment indicators, because one thing I want to mention is that even the bulls who've been very, very stubborn, or a number of them, Wall Street types, are starting to get bearish right in here, right? I mentioned the other day, one firm who had a 4,800 year-end price target, right, way up here, now has a 3,600 price target, and we're about there already, okay? And Morgan Stanley says 3,000. Mike Wilson, their chief strategist. Now he's been pretty bearish throughout, and I've been thinking rightfully so. There's some still very, very stubborn, think we could have a good Q4 rally, and I think that's possible, particularly if it gets worse before we get there. So that's one thing. When I see bulls capitulating, then I'm starting to think, oof, we may be getting close to the bottom of this thing, maybe. Other things that we're seeing on a very short-term basis are really sentiment related. So this is the net future speculators position, and this is updated as of every Tuesday, and this is last Tuesday's look. And so folks, this continues to be a really heavily shorted index, the S&P 500. And as you know, because we've talked about it 1,000 times, when you short something, you borrow it, and then ultimately you have to replace what you borrowed. People who short think that what they borrowed is going to get really cheap and they're going to be able to buy it back at a much lower price and then replace that and pocket the difference. That's what these folks are betting on. If and when the market moves against them, though, they can lose a phenomenal amount of money. So that's when these shorts are covered. Also, I talked about what our experts on the underlying, positional dynamics for the market are telling us. There's been a phenomenal amount of put buying. And the dealers, for the most part, will short the underlying delta hedge right off the bat, because if the market does go down and they're short a put, meaning they sold a put, they're the counterparty who is on the hook to the folks who made all the money because the market indeed fell. So they'll short the underlying security to a certain extent to protect them against huge losses. As things accelerate to the downside, they have to hedge more, called gamma hedging, but that doesn't matter. They'll continue those hedging activities to continue to protect themselves as things accelerate to the downside. More shorting just exacerbates the downside, right? But all of them are short positions, right, that ultimately will have to be bought back. So when these options expire, if they're not immediately rolled, these put options, and then immediate hedging of that goes on, if they ultimately expire and go away, or the market starts to go up, in the other direction, well, then these short positions become a liability that have to get covered. So I can go on and on. There just looks like there's a lot of that going on under the market. So a move in a positive direction could be exacerbated to the upside, just like this move here this last week has been exacerbated to the downside. Another thing that is really jumping off the page at me is the put-call ratio. Typically, it's put volume versus call volume, but it basically tells you there's a lot more activity, a lot more buying of puts than there are calls. As you can see, that is historically a high equity put-call ratio. And look when we've gotten, above this level before, right? December 2008, just before the bottom in COVID. Okay, so here we are right now. So you'd have to say from a contrarian standpoint, there's just too much bearishness out there. That bearishness has to get unwound because the market pops a little bit to the upside. That could exacerbate an upside rally. And then I want to show you just real quick two things and then we'll close. American Association of Individual Investors, hugely tracked data, comes out every week. This last report, and this is a survey they do, what's your 6-month outlook for stocks, etc. Crazy low bullishness right here, 17.7%. The average is 38. Hugely high bearishness, 60.9%. The average is 30.5. Huge number of people piled in. From a sentiment standpoint, whether their actions reflect that or not remains to be seen, but certainly when they're answering the survey, they are bearish by definition, and that tends to be a short-term, very bullish phenomenon. Now, I will say that you got to be careful with sentiments because some people can just take it and run with it. In a bear market, in a real desperate bear market, you can go back to 2008, you can go back to other times, as it's careening, you want to be careful with these because once we hit this high bearishness, you don't just rush in and buy because it can stay there, particularly in a bear market. Now, if we were in real bull market conditions, which we are not, that would make me resoundingly bullish. It does make me short-term bullish for a bear market rally. But I still, as I said yesterday, do not have the conviction that we had at a couple of points this year. But this is interesting to look at. But it's not the be-all, end-all. I'll say it again. In a steep bear market sell-off, that bearishness can be there for a while. And yes, when we come off the bottom, it typically is there before we come off, but you just don't know when that ultimately is going to be. But right now, that feeds the bear market rally case for sure. Lastly, from Investor Intelligence, advisor sentiment, newsletter writer sentiment, just dipped into the net negative. So bears right now outnumber bulls by 1.4%. There were still more bulls as of a week ago. You can see, here's their little graph here below. You can see a negative reading there tends to correspond often with market bottoms. This isn't all that negative just yet. By their analysis is not where you would back up the truck. This was right here, but this isn't, right? And remember, we were very bullish just for a kickback rally right back in here. And of course, this had something to do with our feelings there. We're not quite there yet, but we are extreme on the put call ratio. We keep coming back to that right now. just as of Friday. So we'll see. So folks, I think there's the makings of something there. A lot of people aren't feeling it, which ironically supports this whole contrarian attitude. But keep in mind, we don't think we've seen the bottom just yet. And this could be it. It could be getting that move down in that direction. We said a while ago, I've just kept with our longer term charts where we came up with that technical 3,500 target. It did point to, to the fall of this year. People are asking me, I said, again, let's be careful with market predictions. Let's be humble and intellectually honest. So of course I don't know. But if I've had to put a timeline on it, I'd say anytime from here to the first quarter of next year, if our thesis and our overall analysis holds and we don't have a severe recession looming, for the ultimate market bottom, that would be my timeline right here, all subject to change. So folks, I'll leave it there. Thank you as always for watching and listening, and I'll be back next week. Have a great weekend. Bye-bye.